A very warm welcome to Harish sir. It's really a privilege to have you. Everybody in the session is aware that Harish sir has more than 2 decades of equity markets experience. He's currently senior fund manager at Kotak AMC and currently manages about 4 to 5 funds, 4 to 5 schemes where one of them is Kotak Blue Chip, which has AUM more than 5,000 crores. So it's really a privilege to host you, sir, today as part of Stalwart series at Finacle Institute. And without any further ado, sir, would like to welcome you on board. And sir, as we discussed, if we could get some insights into how you go about taking a look at investing, how you go about analyzing businesses or industries in the first half hour of the session, and then maybe we have quite a lot of questions. We have our alumni who have as well joined us, who are currently working in the industry, and ongoing batch students who are really excited to learn from you as well. So thank you so much, sir. Without any further ado, over to you.
Thank you, Shailesh. As much as I'm sure all of you are hoping that you can quote unquote learn something, I'm hoping to do so myself. And in the process, I think I will try and give you some of my mistakes. The way I would put it is the mistakes that I've made and what I've learned from them. If there is one advice, and if people want to sleep through the next whatever half an hour, 45 minutes, I would say that make as many mistakes as possible, but learn from them and don't repeat the same mistakes. If you can do that, I think you are on your journey of improvement. So let me start by sharing my screen. Um, just let me know whether it's visible.
Yes, sir.
Okay. So, like I said, the idea is obviously over the course of the last 2 decades or so, I started out as a student of the market, and I continue to remain a student of the market. And one thing that markets clearly teach you very quickly is to be very humble, because otherwise markets will ensure that you are taken to the cleaners more quickly than not. So what I'll try and do over the course of maybe about the next 35, 40 minutes is give you some sense. And let me be very honest, as mutual fund participants, I'm not here to talk stocks. I will touch upon some sectors, but all of this is purely from an educational point of view. It's got nothing at all in terms of any recommendations, any sector insight, etc. So please take it from that point of view. And secondly, what you will see over the course of the next 35, 40 minutes or so is that it's not going to be a sequential curve. Okay, this is building to the next, is building to the next. I'm going to deliberately keep it as chaotic as how the markets can be. Right. And I'll try and give you 2, 3, 4 my quote unquote insights, and then we can cover up and kind of string it all together in the Q&A session if any of you have any further probing questions on that count. So I'm a big proponent of first principles investing, right? And the nature of first principles investing, I think, is best taken from Sherlock Holmes, the Arthur Conan Doyle's hero, wherein he says that when you've eliminated the impossible, whatever remains, however improbable, must be the truth. Okay. Now, this, to my mind, is what one needs to have when you're getting into this business, that you have to first believe that every management is a chore, every company is not worthy of investing, and then slowly get encouraged that, okay, maybe there is something, and you have to peel an onion layer multiple times before you get confident that, okay, this is something worthy of my money. And this, in some sense, and obviously, I didn't realize it at that point of time. I was very fortunate that when I was doing my MBA, I was taught, among other faculty, by two practitioners. One was Mr. Manish Chokani, whom I'm sure many of you may have known, and who taught us, portfolio management as a course. Again, a lot of what he taught just went over my head. I would think so. It will be the same even today. The other practitioner is a gentleman by name Professor Rajesh Tiwari, who used to teach and practice at UTI Institute of Capital Markets, and then he went on to be, the senior executive at UTI Bank, overseeing credit, etc. But the gist of whatever he had, and I'm just saying this so that you get the context of what I kind of mean by the slide. His only one assignment in that entire course was as follows. You are all in your 20s. I'm talking about when I was in my 20s doing my MBA. And he said that, okay, imagine that you all get placed, you go to various companies, blah, 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 you make a lot of money. And at 40, you decide that, okay, enough is enough. The rat race is not for me. And whatever savings you have to invest in one stock. Okay. And that you have to invest for the next 20 years. You go off to Himalayas, you have no idea how companies are doing, what they are doing, etc. And at 60, you have to come back and live off that for the rest of your life. Okay. And at that point of time, it never struck what he was trying to say. But when I look back over the course of the last 20 years or so, it actually taught me the importance of longevity and survival in this business. In this business, if you survive, if your company survive, that is like half or maybe even 60-70% of the battle won. And that is very important for all of us to understand, because we, as young minds, we get carried away by the fad, by the latest happenings here and there. It is more important to think of the durability. And when you look at your DCF equations, etc., if you will think about it, I mean, and while a lot of us focus on, next year's earnings, the next 2 years, 3 years, what really matters is the terminal value, in the sense that of the total value, the terminal value, depending on, of course, sector to sector, stock to stock, can vary from anywhere between 50% for a very cheap company, quote unquote cheap, to something as high as about 95-98% for a significantly expensive, quote unquote company. Right. And therefore, this terminal value concept is very important for people to understand. And it is in this context that I think one needs to have this critical thinking of first principles. Don't go blindly by saying that 10p is cheap, 30p is expensive, which is how I started my journey. These were the easy things that I had to unlearn and made a lot of mistakes on, which is why I'm saying you have to go multiple layers down to arrive at this thing. So that is as far as the first principles thinking is concerned. This is something I'm sure many of you may be aware of. If you're not aware, this is basically a concept called the Dunning-Kruger effect or syndrome. Basically, in every faculty, in every profession, competency and confidence have a very different curve. In the initial years, as soon as you step out of your B schools, etc., and you would have learned, DCF and Monte Carlo simulations, advanced macro, computational finance, quants, whatnot. The idea that, you've uncovered Holy Grail becomes so high in all of us, and including me, when I started out 20 years ago, that you think that whatever little that you are learning or whatever little you have learned is actually got a very high confidence interval. So you start projecting, in your DCF assumptions to the second decimal point, to the third decimal point, thinking that that is what is going to matter in your quest for finding the true value, quote unquote, value of a company. Unfortunately, and I guess what typically happens is initially market rewards you. It's like the beginner's luck, right? In a casino, markets reward you, and then they suck you in, and then they pummel you so hard that you will feel like, you're a complete loser in life. And this is really the peak of Mount Stupid. Now, I was very fortunate that I got to the peak of Mount Stupid very, very early on in my life. I made so many mistakes. I joined the markets in 2004-5. As you could have imagined, that was really the middle of the peak bull market that we've seen in this generation. Insane amount of things were happening. You go and meet a company, you go and meet a sugar company, then the management comes and gives something, yeah, sugar season is good, blah, blah, blah. You project the next year's EPS, and the next day you go and buy the stock, 3% of the portfolio kharid lo, bas. And you know what? It was insanely rewarded during that point of time. And you start thinking that this is the way life is. 2005, 6, 7, 8. You start thinking that, hey, this is wonderful. This is like cowboy style, right? You get your hands dirty, and you immediately invest basis that, as they used to say, invest first, investigate later. At that point of time, in the throes of the bull market, and there were so many companies. I mean, my wall of shame is so littered with names that if I think of the names that I have invested in, I feel, I mean, I'm genuinely embarrassed of the mistakes, the basic mistakes that I've made. I would never even think that, I should be ever handling money of people, let alone my own money in that. But like I said, thankfully, these were small mistakes with small pools of capital. And then when you start going down, you have a huge amount of self-doubt. You start thinking through, is this right? How can this be right? What really is making me confident? Your confidence interval starts plummeting down, right? And then you reach that value of despair. And I reached my value of despair in 2009, 10, wherein even after buying good companies, nice companies, cash flow companies, I was still not making money for my investors. And that was true for a lot of us, at my firm. And that is when you start looking at the value of despair. You start wondering whether, you are even cut out for this job. Do you even want to do this for your living? Because every day you're getting beaten black and blue by the markets. Some other competition is doing better than you. You don't feel nice. And then there is a slow slope of improvement. And this journey, friends, whatever I say, whatever I tell you about my mistakes, it will never ever be the same for each and every one of you. You will have to make your share of mistakes. You will have to pay the tuition fees to the market. It has to strike you that you made an obvious mistake. Until you don't do that, and hopefully, like I said, if you're not going to learn from that, then you are never going to get into that slope of improvement. And then, yes, of course, there is going to be some kind of a phenomenal learning curve, and then some kind of plateauing. So it's important to understand where we all are, as much as all these series of Gyan that you must be listening from various experts. I think there is no substitute to paying the market tuition to Mr. Market, right? Now, which brings me to this point that in your journey as professional investors, or on your personal portfolios, you will have to be in this journey wherein every 3 4 years you will have to kick yourself and say what an idiot I was to have been doing it this way. And that is when you get your light bulb moment. You start realizing, oh, in a completely new way, that this is how you should have looked at. And obviously you can't be getting a light bulb moment every 1 year or every 6 months, because then it is of very little utility. But and possibly many others get maybe once in a lifetime or twice in a lifetime. I've been fortunate or unfortunate, whatever you can call it, that I've had a light bulb moment 4 times in my professional life in the last 20 years. And it also means that that I was doing something very stupid before that. And so a part of my journey of whatever I'm going to speak about is essentially a synthesis of these 3 4 light bulb moments that have come through. And you will have to get through that light bulb moment. You have to kick yourself. Yeah, what an idiot I was, that I was doing it this way when it was so obvious that I shouldn't have done it. Now, that can only come when you have self-reflection. It's very important. And, this may sound like a philosophical gyan, but believe me, if you're not going to introspect, and I'll tell you how, I've gone about and how I think you should, you are never going to learn or be on that learning curve, which is important to be a better investor. So let me start with one of the few light bulb moments, or some of the basic tenets, that this is a business which is hugely probabilistic, right? And therefore you need to feel lucky. Now the question is investment luck or skill? Or hot hands, great fund manager, blah blah blah. Is it really all that, or is it purely skill, or is it pure luck that we are seeing so and so person operating at that point of time? More importantly, is there a way in which you can know whether you're feeling lucky? And is there a way to improve the luck quotient? It is important to first understand how much the role of luck is there in this industry, because we can get very carried away by the amount of money we manage, by the amount of adulation that people shower upon us, because this is an industry wherein some days you are the bird, some days you are the statue. Markets and market participants and investors will shower their praises, and they will. This is like being a cricketer in India, I guess, right? That and everybody is a fund manager. Yeah, whether you like it or not, everybody, every driver, everybody knows. Oh, ये तो लेना ही था, ये तो इतना सिंपल था, इतना भी नहीं आता है आपको, फिर आप किस चीज के फंड मैनेजर हो? These are common retorts that you have to encounter, and we all do. Okay, and at every level. It's not that it is only in the first 5 years, and after some time people will stop saying. I think even after 20 years, there have been episodes wherein people will say कि क्या भाई इतने साल हो गए फिर भी इतना useless इतना basic mistake किया आपने. And that is the reality, that it is going to be that. So it's important to understand how lucky or how luck can play a role in everything. Now, there is a beautiful book called The Paradox of Skill. If you haven't looked it up, I would strongly urge you to do it. It's written by the gentleman called Michael Mauboussin, who's, I would imagine, one of the best thinkers as far as the investment field goes. Now, how do we know whether any profession or any activity involves luck or skill? Is by the simple aspect, can you deliberately lose? Okay. If you can deliberately lose, there is skill involved. If you can't deliberately lose, there is luck involved. Now, think about all of this, reflect upon this statement. Can you deliberately lose? Can you deliberately say that you want to underperform Nifty over the course of the next 6 months or over the course of the next 12 months? Can you do that? If you think you can, you'll be surprised that how much randomness plays in the next 6-12 months. You can have a longer term view, which can be over the next 5 years, that you can, if you buy broken balance sheets, if you buy junk companies, you are more likely to go into ruin. But can you do that, which can play out in the next 6 months, next 12 months? The chances are insanely impossible. So he gives this beautiful example of Usain Bolt, right, to explain where he is in the luck skill continuum. He says if Usain Bolt chooses that he wants to lose the race, he can lose the race. And that is a level of 100% skill, right? If you're competing against Usain Bolt, unless he chooses to lose, there is no way that you can win against him. Now, that is the epitome of skill, and there are obviously many other examples. But when it comes to investments or most other sports, there is a heavy influence of luck involved. And so there is, I haven't put this on the slide, but for those of you who like long form reading or Substack or even on Twitter, where I'm quite active, I have published something on the luck versus skill, or how lucky you are as a continuum in terms of markets. And we can easily identify, when the how lucky things were in 2020, 2021, especially 2021. And how insanely difficult things have been in the last 18 months. So which is where the luck versus skill clearly starts coming through. Okay. This is, I think, a very important aspect of understanding that markets are a probabilistic endeavor. Investment is a probabilistic endeavor. And therefore, it is very important to understand that, every path will open up to multiple paths. That will open up to multiple paths, and so on and so forth. And therefore, just because an event happened and your portfolios did so and so, be it in terms of back test or even in terms of actual performance over the course of the last 5, 10, 15 years, it is just one instance of how things could have been. And this is very, very important because it will improve your thinking, in my opinion, to think of probability as one of the basic tenets of investment. You will have to get at your base rate of investing. Where are your odds of success higher? And even within that, what is your rate? It might surprise you to know that the hit rate or winning rate for most fundamental investors, okay, is as much as 51, 52, 53%. That's all that it takes in this business. In this business, if you are in your 50s, especially if you are in 55, 60%, or even sometimes, of course, you can be at 60, 65, you are a very, very rare breed. Most of the times, people would be in the 40s, okay, which means that you are going to make more mistakes. You're going to get more failures than hits in your investment journey. And therefore, it is important to know that 51, 52 is not a bad outcome, but that 51, 52% of hit rate can be improved if you are focused on a particular sector, if you're focused on your particular competency, wherein that hit rate can then move up to say 60, 65%. So it is important to know what your hit rate is. And that hit rate, there are various ways. I mean, if people are interested, I can cover that maybe in Q&A, in which we try and look at how to look at hit rates and how we can improve the repeatability quotient. So this is essentially the problem statement of man or machine, right? Broadly, there are three dimensions of investment. And I'm talking this not from a stock or from a sector point of view, but from a strategy, be it man versus machine, active versus passive, all of those dimensions. And which is that three dimensions? The first dimension is insight. Do you have a unique investment proposition which is different from the rest of the crowd? Okay, and that is how I look at insight. And insights can be insanely profitable because you're going against the crowd, and that is where you are going to make maximum bang for the buck. The second dimension is that of repeatability. And this is where I think certain people fumble and many others succeed, which is that given a similar backdrop, will you be likely to pick similar kind of companies, similar kind of things, so that you get a repeatable kind of an outcome? So if I were to give an example, let's say that value as a style is where you are focused on. Now, if there is an economic backdrop or a regime which favors value, at that point of time, will you as a fund manager at least outperform at that point of time to more than make up when things don't go your way? And the third is, of course, cost, and which is obviously the more debated aspect when it comes to active passive, that, costs are higher on active, lower on passive, etc. But the reality is, I think cost is a very small aspect. I would say that the bigger two dimensions are insights and repeatability. And this is where I would think that when it comes to insights, man is extremely superior to machine. The fact that you can have proprietary insights means that you can be insanely profitable if you get that calls right. The problem for men or fundamental strategies or active strategies is that, unfortunately, we are all prone to biases of greed and fear, which is where I think machine scores very strongly, which is that it tries to remove that influence of biases. So is there a way in which you can combine both of these to come and arrive at better hit rates and better improving odds, is what really investment, in my opinion, will lead to better outcomes as a professional. So at Kotak, we look at it in the form of two ways. One is quant assisted fundamental, which is basically that people still use the fundamental dimensions of valuations, of meeting companies, of assessing companies' strength, the moat of companies, blah, blah, blah. But you also get a risk measure based on what the feedback loop of the market is. Are people getting too risky? Are people getting too adventurous, etc., etc.? So obviously valuation is one aspect, but there are multiple other ways in which you can assess the temperature of the market. And if you combine these two, that is essentially what quant assisted fundamental is. The second approach is basically fundamental assisted quant, which is basically that you use the power of compute to give you the entire portfolio. But obviously, as we all know, garbage in, garbage out. I'm sure there is a lot of craze about AI, chat GPT at this point of time. I'm sure the industry is going to launch many AI products in the hope that it will give you outperformance. But let me tell you that in the last 5 years, there has been an AI ETF launched in US, which has been miserably underperforming already. Okay, so garbage in, garbage out, right? And so what we think is, even for this to succeed, you need to use the behavioral attributes, the thinking of how human kinds evolve, to give in as rules to the machine so that it can come up with better outcomes. So these are the two broad ways. Both have got their own pluses and minuses. And both of these dimensions is what I have worked as. So one of the light bulb moments, I would say two of the light bulb moments that I had in recent, one was using quant assisted fundamentals, which has helped me significantly. And I'll cover a few cases in the next few slides in terms of helping me assess risk in the markets. And the other one is to go completely in terms of quants, but using the fundamental insights and the attributes of behavior to improve the odds of quant over there. The reality is, and which is the thing that it's important that all of us understand, is that in markets, we'll never get 100% information to make a decision, especially as minority investors, which we all are. We are not promoters, we are not management. We will have maybe 65-70% of all information. Now, the starting point of information is, of course, public disclosure. And, Google Zindabad, you can have Screener, you can have Bloomberg, you can have all kinds of things to get you up to speed over there. The next set is basically your information edge, which is how you're going to differentiate from the rest. And I'm not talking about insider information, etc., but through legal, ethical means, be it in terms of scuttlebutt, be it in terms of management interactions, ethics, etc. How are you going to improve your information edge so that you can reduce the noise? The key aspect is there is a lot of noise today when it comes to public disclosures and whatever is there. From that noise, if you're going to distill something, what is it that you're going to distill on is what the information edge is going to be. The next is going to be the diligence edge, which is that you have to start looking at pattern seeking. And pattern seeking, has got a very bad name or a bad reputation. Many people think of it as technical charting and all that. But at the end of the day, be it fundamental, technical, quant, everything is about pattern seeking. Basically, some aspect what has worked for you in past is basically getting wired into your brain that, okay, this is where my hit rates are much better. And that is what I have to do, right? So if you are able to identify patterns, so let me give you one pattern that has worked very well as a fundamental investor, which is management change. Whenever I've seen a management change preceded by, say, 5 years of significant underperformance of that stock, I've generally seen that the next 1 to 2 years have been very good for that stock. Primarily, the narrative is all beaten down, margin of safety is very good, and therefore a new guy comes in, he or she brings in a new kind of dynamism. Some of it will work, some of it will not work, but markets get sucked onto that narrative, and that is where you make that arbitrage. Now, this is a fundamental insight basis what I have experienced in the last 20 years, wherein I have deployed money and I've seen that the chances of it are much, much higher than that 51% that otherwise, markets typically operate at. Similarly, you can make enough number of insights and synthesis. When I say synthesis greater than analysis, many people go deep down a sector, deep down a stock. But I think there is a lot of benefit by going higher up as well. So you are able to connect the dots far, far better when you keep going higher and higher up. And that is where I would say that both synthesis and analysis are important. Personally, for me, I have seen greater differentiation from synthesis than analysis. So that is as far as the diligence is concerned. The final point is the behavioral edge. At the end of the day, your gut is what is doing all the hard work. The brain is going to support you only so much. When the stock when the stock is down 70%, 80%, which happens to all of us, the reality is that, like I said, we operate with incomplete information. What is it that you're going to do? Do you have a process? Do you chicken out? Do you double down? How do you decide? Which is where the behavioral aspects get extremely important. You need to start incorporating feedback loops in your overall process. And lastly, all of these need to have a risk management framework. So essentially, this is the template that we have, be it as a fundamental investor or a quant or some other alternate way of investing, which is that you need to start deciding with incomplete information, but you need to have a process by which you are going to do that, which will get you a hit rate which is much more than 51, 55, 60%, wherein your odds dramatically improve. so that you can be successful in markets. Now, again, going back to my MBA B school days, uh, the profs used to tell me that 0 to 50 you can get from Google. 50 to 65, 70 is where you are going to get from all the others, be it that of scuttlebutt, be that of diligence, be that of behavioral edge. Now that 15, 20% is what is going to differentiate you from any other investor who's got some basic information from Google, right? Which could be screen array. And when I say basic information, I'm not saying that, just looking the last 3 years annual report. The market is very smart. They do a reasonably good job going through annual reports, going through cash flow statements. All of that is part of the 50%. But 50 to 65, 70% is the art which you have to imbibe and you have to learn through. Now, how do you get from 50 to 65, 70% is the key. So one way in which the prof used to say is, imagine that you've got one chance with the management, okay? What are the 5 questions that you're going to ask the management that will take you from 50% to 65, 70%? Now, this is again something which is extremely important because these 5 questions are never going to be the same for every company. They are going to be extremely contextual. More importantly, when you're thinking of, longevity, terminal value, and all of those, you pretty much decide that, all these near-term worries of, slowdown here, some regulatory action, none of them would be part of your 5 questions. You will have to start thinking much, much deeper, thinking as to what they look in their businesses, so that you can try and be a partner along with them. And these 5 questions, I would say, are possibly a very good way to think about improving the overall process. Now, if you really look at any portfolio manager, most of us think that investments or portfolio management, the role of a fund manager is only 2, which is buy and sell. But the reality is actually there are 5 key decisions that a fund manager takes. The first is, of course, buy, right? Now, what do you buy and what is the buy premised on? It's basically focused on mispricing. You're going to try and create a thesis as to why a particular stock or a particular space is underappreciated by the market. It could be long or short, depending on what it is. But it is going to be the fact that you think that there is a particular insight that you have, which the market currently in its wisdom is ignoring. Now, this is actually going to be maybe only 10 to 15% of your portfolio. Many people think that it is going to be like 80, 90% of your portfolio. But the reality is that if you're going to be sharp, if you're wanting to play in odds wherein your hit rate improves quite dramatically, this is going to be actually a very small component of your overall decision making, which is that where is the mispricing? It might be 15, 20, 25% at best. It cannot be more than that, which brings me to the most important aspect, which is reinvest. A lot of us forget that ultimately you need to compound the capital, which is that you need to be present in businesses that do not erode capital, but at least grow along with the rest of the markets, right? And which is where maybe 75, 80% of your money is going to be residing in. Whenever you see a mispriced opportunity, either you take from the reinvestment pool and get into the mispriced buy, or you have to sell something and get into the buy zone, right? These are the only 2 ways. But whenever you are out of buy ideas or mispricing ideas, you come back into the market beta, if I'm talking from the lens of the quant, or you come back into compounding machines that at least over a period of time will kind of grow along with the cost of capital. So this is the second attribute. The third attribute is that of sell. Now, selling is where we all suck. That is the reality as human beings. And there is this brilliant paper. I forget the name. And this is something that, again, I have referred very recently in some of my posts, which is, I think, selling. I forget the name of the paper. I can get back to you on that, or you can see it on LinkedIn or Twitter, etc. But basically, they have analyzed the last 16 years data from 2000 to 2016 of professional fund managers, around 4.2 million decisions. Okay, this is a treasure trove of data. And what they have found, and this is basis US professional managers, a lot of professional managers. I think the total money that they were managing was close to about $500 billion, split across multiple managers, of course. And what they have generally found is that most professional managers actually add a significant value in their buy decisions. That buy decisions typically outperform the broader market by anywhere between 200 to 250 basis points. Okay, over a period of time. It is actually the sell decisions which is the most lousy, wherein they lose anywhere between 100 150 basis points against the markets. And then when you add the cost, etc., is where we get to the sad state that many professional fund managers do not really add value to the market. Essentially, our sell decisions are mostly filled with regret. What is the regret? That if only I had sold too early, or if only I had not sold it, it is compounded even more. I could never have forecast. So there is always going to be both. Okay, as we all know that investment is both an art and science. It is numbers and narratives. But if you really ask me, as a fundamental investor, if you have got a better sell discipline, it is like doing 70-80% of the hard work. Most of us, unfortunately, are wired to spend most of our time in buy, lesser time in reinvest, even lesser time in sell. Okay, whereas what I would think is we need to spend maximum number of time in reinvest, same amount of time in both buy and sell. Both are very important variables, and which is where I think sell gets a lot of thrift and misses out. And the last thing is, of course, portfolio construction, which is in terms of weighing schema. Most of us think that stock selection is what a lot of trick is, but I think there is a lot of merit in portfolio construction is a very underrated concept, and that is what is going to see you through the day to ensure that you survive, right, which is what is basically risk management, etc. The last aspect is rebalance. How do you kind of get into a concept wherein you need to rebalance your entire portfolio? What is going to be the key decision that is going to trigger it? And be that as a fundamental investor or as a quant investor, and I wear both the hats, I can tell you that all of these decisions are the same or similar, let me put it, be it for a fundamental or a quant investor. It is important not to think of them as two completely different black boxes, etc., the way they operate. And therefore, I think, you will have to look at each of these decisions as objectively as possible. Very quickly, and this is for those of you who are interested in quant, and this is, I think, the only slide I have on quant. We can have as much, questions on quant because that's something I'm very passionate about. It's one of my light bulb moments, like I said. But if I really look at, the stacking up of each of these 4 decisions or 5 decisions between fundamental and quant, if I really look at it, as far as fundamental is concerned, the buy heuristics are basically past data plus an individual assessment of future, right? You have to be differentiated, and therefore you can't be looking at what the market is thinking, and which is where the individual assessment is. Where fundamental really scores very high is on the diligence edge, because most fund managers are very wary of their reputation, career risk, etc., which means that we want to reduce the error of commission. Unfortunately, by focusing a bit too much on that, we also miss out on opportunities and we commit errors of omission, right? That's the trade-off that we are doing. But what we are generally very good at is that we don't want to be caught in names which otherwise are got very, very return characteristics of, which can be zero. We want to play a lot more safer in that safer zone. Reinvestment, if you look at it, unfortunately, out of sight is out of mind, predominantly dominates the thinking, which is basically that if I get out of a position, and it's again part of the same article that I referenced in the previous slide, if you sell out of a position, the chances that you will buy back that same position are very, very remote. The moment you get out of a particular position, and this is true for when I look at my last 10-15 years of data as well, if I get out of a particular position, I'm so biased against it that I'm unlikely to get back into that same position. So which means that most portfolios end up having tracking positions, that even if they think that something is not going to work out, let me have some position of it, let me not completely get out. And so therefore I will moderate the weights. That is what determines my weighing schema, unfortunately, which is a suboptimal or a local optimization that I'm doing instead of a global optimization. Selling, like I said, is where all our mistakes as far as fundamental investing is concerned. And when I look at rebalance, it's basically an asynchronous rebalance, which is basically that I'm not going to change my entire portfolio on one fine day just because something has changed. I'll be looking at only maybe 2%, 3%, 5% at best of some change, which means it's a very asynchronous. For each stock, for each business, I'll think in a different lens than through the same lens that I'll think. Now, if I look at quant, what am I doing from a buy heuristics? Again, the data is the same, be it of what a fundamental investor or a quant investor is looking at. But what I'm looking at is the wisdom of the crowd. And which is where, things like momentum, things like low wall, etc., as factors. If for those of you who know factor investing, a lot of that starts coming through. The wisdom of the crowd is pretty much doing the heavy lifting, wherein you believe that the markets are sharp. Now, obviously, we all know that markets cannot be always right. Bhav Bhagwan Che is true, but you need to know the difference as to when to listen to the markets and when you think that the markets have gone completely maniacal. And which is where I think that fine line and the judgment needs to come through. If I look at the diligence edge, generally, it is very poor. Of course, you can improve it. You can have forensic tools. You can look at various other measures in which you can improve it through big data, Benford law, etc., etc. But the reality is, on the fundamental side, the diligence edge is going to be a lot sharper than through any kind of machine, right? But the reinvestment and selling is where quant really scores very highly, in my opinion, which is that in reinvestment, the basic investment thesis is at least maintained. If it is not there, it is not going to be there. There is no such bias of out of sight, out of mind. And same with selling discipline. The key strength of quant is that it is selling discipline is extremely sharp. Of course, what it unfortunately brings in is high churn, right? And that's the problem because it's got a synchronous rebalance cycle, which is on one particular day, the entire portfolio sees a completely new signal and you try and affect it across the length and breadth of the portfolio. Now, there's no right or wrong on both of these approaches, right? But it's important to know the differences in either of them and try and see if you can marry some of the positives in both so that you get an outcome which can be the better of both of them rather than the worse of both of them. So I think it's important to know beforehand what the positives and negatives are and to have a first principles approach of trying to synthesize both of these signals to come out with a better tool. Okay. At the core of our business, there are only two patterns that we are all looking for, be it as a fundamental investor or be it that as a quant or a technical or an astrologer, whatever be it. We are looking at only two signals. What are the two signals? The first signal is trend or momentum, which is if I'm looking as a fundamental investor, and I'm just giving an example of Bajaj Finance, which has done very well, blah, blah, blah. You think that Rajiv Jain is the lucky charm. You think, okay, what is it that he's going to do better? You start extrapolating, okay, they've done this right. Now they're going to go on. Let's take the case of, any large conglomerate. They've done exceedingly well in one. You think that they'll be extremely good in the other new venture that they have got because of their past learning. So that is the trend or momentum. Now, in the factor lens or in quant, it is basically what has worked in the past is likely to continue to persist, right? And the second signal is mean reversion, which is that you are trying to say that, okay, boss, bahut ho gaya, abhi reverse hona hai. Now, I'm not a big fan personally of technical indicators, but most technical indicators also basically rely on only these two. Like I said, fundamental investors also rely only on these two. Quant investors also rely only on these two. Now, the key important attribute is when should or where should one look for the first and where should one look for the second? In my opinion, lower you go down the curve, the better signal to look for is trend or momentum. Higher you go up a curve, you have to look at mean reversion as the primary signal. Let me give you an example of what I'm talking about. Okay. If I'm looking at a particular company or a particular division or a particular individual who's got a brilliant track record, the chances are that that individual's track record can sustain for much longer. If you're going to keep betting that, Jeff Bezos is a failure. However exceptional that could be, ours, rare that feat is, I think that you're setting up yourself for failure. If you think that Sachin Tendulkar is an average bloke and his performance will mean revert back, you're setting up yourself for failure. So lower down the curve that you are in, which is in the form of a division, in the form of a company, the chances that what has worked is likely to keep working for from a fundamental. So if earnings are good, if there is a company with very high ROE, the chances that it can persist with high ROE, I would say there is a reasonable chance to look at it rather than through. So if there's a great company, you need to give the benefit of doubt at least that it can continue with its greatness. But as you keep going higher and higher, so if you're looking at a sector, for example, the reality is that a sector will be made up of few great companies and a lot of mediocre and some very laggard companies. And then when you look at it, that okay, tech is going to do very well, the chances are, yeah, tech as a space can continue to become insanely very large. But then at some point, the laws of nature of gravity, etc., will mean revert. And so you can try and start plotting mean reversion over there. From sector, you go to market cap. From there, you go to country. As you go higher and higher, the focus that you need to look at is mean reversion. And it could be in the form of valuations, it could be in the form of trading cycles, it could be in the form of the clock, etc., etc. But these are broadly, very simplistically speaking, is what we are all in this business for. Now, let me give you an example of how we look at reversion from a sector allocation. Now, again, this is just an example. We may be right, wrong, etc. So what we look for is a three-dimensional analysis. Okay, the first dimension is basically profit pool share. The second dimension is market cap share, and the third dimension is ownership share. Okay, these are the three dimensions that we are looking at for a sector, which is like I said, as I keep going higher, you want to look at the mean reversion as the key trend, right, or the key variable. Now, if I start out with the profit pool share, if I start out with the profit pool share, you start to look, and this is data over the last 20 to 23 years, right? That the profits vary from say 1.5% to 10% of total profits for a sector which is cyclical like that of auto. Now, we know that it's a cyclical sector. Currently, it's at about 3.5%, 4%. You want to buy a cyclical sector when the earnings is close to its bottom half, not at its top half, because you know that when sector is really good, it'll start throwing insanely high profitability, but that's the time when you want to get out of that particular sector, right? Similarly, we look at what is the market already perceiving. Now, in certain cases, the market cap share will be even lower than the profit pool share, which means that it is actually derated it significantly. For example, currently, if you look at it, media is a space where the market cap share is even lower than the profit pool share. It happens very rarely. It is not very often that that you see that, especially in sectors which are otherwise quote unquote sexy or glamorous. But in many cases, you typically tend to see for a growing sector, profit pool share typically trails that of market cap share. Again, you want to buy where the market cap share is lower. So in this case, for example, market cap share has varied from about 3% to 10%. And currently it's at about close to about 5%. Okay, so you are again betting on reversion as the primary signal. And the third dimension is ownership, wherein we look at other funds data, other how ownership patterns, is it primarily only with the promoters, or is it already bought, etc., etc., to arrive at a thesis. Now, obviously, this is only one bet as a sector that you do. You will try and keep as many bets. So this is, for example, the cement sector. Again, very cyclical as a space, right? We are talking about cement profit pool at almost a 15-year low as a profit pool share. Now, these are all sectors which can swing quite meaningfully. So from 0.5% to about 3% profit pool. You are currently at one of the lowest readings that's there, which is where I would say that it's a reasonable time for us to assess. Again, you can't be only relying on that. On top of that, you've got judgment. You have to start looking at how things can change over the next 3 years. If you look at real estate, again, something which varied from say 0.5% to about 6%. Currently, we are at close to about 1%. Again, spaces which can materially meaningfully. And similarly, you can look at the other side, right? Consumption, financials, etc., which are close to their all-time highs. in terms of profit pool share, which can potentially reverse. So this is a way in which we look at reversion. In the interest of time, let me start moving quickly. Now, how do we look at market reflexivity? Which is the feedback loops which we use to listen and when not to listen, because there is, like I said, a wisdom of the crowd, but it can also be a madness of crowds. Now, what I particularly pay attention to is to look at niches. Okay. What typically works for, say, 5-10% of the market, when it becomes, say, 25-30-40% of the market, we know that it has become very mainstream. And that is where the chances that you're moved from the wisdom of the crowds to the madness of the crowds starts perpetuating, and you want to be on the other camp. So these are some of the charts that we presented earlier. So I've kind of shared them. So if you look at all of these, right, the multi-bagger count, it's a very mean reverting kind of account. And therefore, when you are at its almost highs, you want to be on the other side. Similarly, this is again interesting chart. So typically, when you look at stocks and index, even as index keeps making new highs, generally you see stocks which make only about 15-20% of stocks generally keep making new highs along with the rest of the market, right? Now there are times wherein almost 50-60% of the companies, for example in the mid 2021, we were possibly at one of its highest readings, right? Wherein close to about 60% of companies in our universe were close to 99% lifetime wealth, which we know is an insanely high number. And therefore, these are the market feedback loops that we look at. Another thing that might be of interest to you, wherein we look at valuation creep, what otherwise only 5-10% of companies account for. Now we are talking about 30-35% of them getting there in terms of less than 2% earnings yield. More importantly, you also look at, say, the trading turnover. How much of the trading turnover these companies, these are no longer in the niches. People are trading them with gay abandon to arrive at, say, 15-20% of trading volumes in these very high PE kind of names, which again, to my point, is a worrying sign. So this is, I think, very clear that you need to know what really you're playing for. Because every trade, you need to start looking at inversion. And this is something which I think Charlie Munger has made very famous, which is that what is your edge? What is it that the market doesn't know that you think you know? Is it time? In many cases, it could be just time, that you think that the market is very focused on the next quarter, the next 2 quarters, whereas you've got, say, maybe a 3-year horizon or a 5-year horizon, and you think that this is a great company which will be able to tide over this difficult time, and therefore you will be able to make outsized gains. So it's important to know what you're playing for, and therefore to have feedback loops also of that style. I think very early on, thankfully, I was taught that the cash flow statement is the most important statement. All of us in our DCF models invariably focus only on the profit and loss. Then we look at balance sheet just to kind of make the numbers match. That's about it. A cash flow statement is just a small footnote that we all get by. But the reality is, I think the cash flow statement is far more important. Same with asset class being more important than sector and then stocks. Like I said, I'm just rushing through because I've taken a lot of time. At the end of the day, I think it's very important that, especially in India, we look at the supply side more important than the demand side. What do I mean by that? In a country like India, wherein every sector, if you think of toothpaste as being one category which is very highly penetrated, at the end of the day, most Indians are maybe brushing at best one time a day. If you make it 2 times a day, it is almost 50% penetration. In India, the consumption levels that we can make any story basis demand. Population growth, J curve, $1,000, $2,000 per capita income, blah, blah, blah. But therefore, a demand side thesis is, I think, irrelevant. What one needs to focus is on the supply side thesis, which is that, is there capacity is coming? Is there pricing power in this industry? How long can profit pools sustain before competition or regulation starts coming through? When we start looking at supply side, which is actually a lot more predictable, that is where your thesis has an edge. Lastly, I would say that, a lot of us focus on EPS. What is more important is balance sheet and return ratios, the efficiency of capital, and that starts getting. So what we focus on, there are various styles that we have, growth, value, etc. What my special focus is on best of breed, which is basically that, in my opinion, every sector is cyclical. Corporate governance is cyclical. Some companies get insanely popular. Some companies get insanely bent to history, etc. But be as they may, I think that companies that gain mind share and market share in difficult times actually make the most when the sector tailwinds start coming through. And our idea is to buy these best of breed franchises when times are difficult. So we don't want to buy cheap companies. These are all expensive companies if you were to look at it, but we want to buy them when the sector is going through a very bad patch, and we be patient so that over the course of the next 3-4 years, the sector headwinds turn to tailwinds, and these are the companies that insanely get rewarded at that point of time. And therefore, our focus is that what are these companies doing different compared to the rest of competition? How are they innovating? How are they improving their longevity of their business? And these are all subjective questions, right? But the way we look at it is, I think, rather than looking at earnings, etc., we look at their capex share in a particular sector. We look at the IP that they are doing in a particular sector. We look at how their margins have trended compared to the rest of the sector. We look at how their capital efficiency ratios are trending compared to the rest of the sector. So rather than looking at absolute, if as long as we think that their lead over the rest of the sector continues to remain or they are widening, we think that this is a case wherein we have a better hit rate compared to the rest. Okay. As I have already said, we want to focus on consolidated sectors. We don't want to focus on sectors where the only variable is demand. And ideally, we want to focus, therefore, on sectors where there is reasonable amount of pricing power. Obviously, these are subjective. Only with time we get there. And so one of the ways in which we look at is how the past track record of these companies are. It's very important to realize that markets are constantly fascinated by growth. But the moment your growth is exceeding your return ratios, that means you are going to constantly need external capital. It could be in the form of borrowings from a lender, from a bank, or it could be in the form of equity raise. Now, in a good cycle where you've got access to capital, this will get insanely rewarded. But the moment the cycle breaks from a capital market cycle and they start saying that we don't want to finance this project, the same virtuous loop becomes a vicious loop. And therefore, we want to focus on internally accreted cash flows that can fund and finance earnings growth. Our preference is boring sectors. We've had reasonable success in sectors like pipes, tiles, gas utilities, cement, sectors which have otherwise not been rewarding in the last 10 years. But within this, I think some stocks within each of these have created insane amount of wealth, which is what our primary focus has been on. And like I said, in our sense, we need to give time for the companies. We are not really looking at 6 months, 12 months, etc., for a thesis to play out. Generally, we look at 3-4 years for it to play out. It's important to understand that they don't operate in Excel sheets. Business is operated in the real world, and this is a slightly dated survey or a study that we have done. So obviously every company has got a sales target, and the sales target is generally to do better than GDP or better than because you want to keep growing faster than the market. The reality is, out of all the 1,000+ Indian companies that we studied, only about 27% of them actually report higher than nominal GDP growth rate. So even the sales growing faster is actually a small minority. Now, if I were to look at how many of them actually grew every year, ahead of the GDP growth rate, the answer is just one. Okay, and even this company, this was a study we did in 2017. Actually, in the last 3 years, even this company failed. So technically, there is no company which has grown every year its sale. Of course, this is non-financial because sales, we are talking about sales, right? Now, if I say that, okay, every year is too much, let me at least focus on 15 out of 20 years. We're talking only about 37 companies, right? Out of them, how many of them at a minimum, at least 15% rose? Only about 35 companies. So the reality is that, whatever we talk about, our assumption is that this company can grow at 15%, 20%. The reality is that the past record of Indian companies to get anywhere close to that has been very poor. This itself has been quite good, but the reality is that, all our assumptions need to be very moderate. If you look at typically, what investors require, it's a big laundry list: long runway of growth, pricing power, capital allocation, blah, blah, blah. The reality is that all of these can be only found in checklist. In the real world, you're going to have to make compromises with, say, 7 out of these 10, or 3 out of these 10 that you will have to compromise on. You have to know that which are the ones that you're not negotiating on, and then go ahead. Which brings me to the study. This is something that I published about last week, which is called super compounders. Right? Now, I've been very fascinated by this set of companies whose sales today is equal to profit, say maybe 3, 4, 5, 6, 7, 8, 9, 10 years down the line, right? So if let's say a company is giving a sales of say 10,000 crores today, and profits are say 1,000 crores, if a company can get to 10,000 crore profit in 5 years or 7 years or 10 years time, it will be classified as a super compounder. So there's a detailed methodology which I've published. In the interest of time, I'm not going through that. But these are extremely difficult, right? Because it's not a simple point to point how many companies compounded their earnings by say 20%. Because in many cases, your starting point is itself very low. Many companies, if you look at say Titan or all of these great companies also, they had maybe a 5 crore profit or a loss in the early stages of life. And therefore, to get very high profit growth is quite high. But to keep getting the profit growth higher than what the sales is, because sales also would have kept going up. We have seen almost a 10x growth in GDP in the last 20 plus years. And therefore, sales also of these companies have kept going up. And therefore, it's like running on a treadmill in a marathon in the hill mode. And then to keep saying that, profits are surpassing that of your sales. Now, if you really look at it, we are talking about 1-2% of companies out of 500 companies, which is typically our universe, who actually end up being super compounders. At the end of the day, maybe 30 companies in the 2022 cohort made it to the super compounded list out of 500 odd companies. So these are extremely tough companies that get it right? And the reality is that this rate is getting even lower, because obviously companies are becoming even larger. And therefore, if you are a 50,000 crore company, to say that your profits will be 50,000 crores, say 5-7 years, is going to be a tough task. But still, some companies have done it. Even better. So if I were to plot the last 20 years and say that if you have at least made it once in the last 20 years, that comes to about 230 or 250 odd companies, right? Out of that, if I'm not wrong, about 80 companies actually did this enviable task without raising external capital, which is, I would say, the best way of growth. Everything through internal accruals, they've been able to fund it with discipline to ensure that their growth continues and their profit margins have kept expanding, so that over a period of time, and obviously they've got insanely rewarded, right? Now, sectors which I've generally identified 4 sectors where it's been more, where the base rates have been higher. One is in terms of chemicals, which is basically materials. You've got IT, pharmaceuticals as the other space, and then you've got capital goods and industrials as the other space, right? But I think the even more important thing is, even in boring sectors, gas utilities, even in sectors which are into building materials, some cement companies, etc. So the point is that there are many such companies which are there, and these are the ones, if you are getting it, and you participate with them, especially. And if I were to tell you that out of these 250 companies, there are at least 52 companies which are trading below 15 times price to earnings on a trailing basis. I'm not even talking about forward. Of course, many of them are also PSU companies, but even outside of them, there are companies like that, right? There are about, I think about 70 odd companies. Again, numbers may be wrong, but there are about 70 odd companies which have given negative returns over the last 5 years. So the point is, even these super compounders actually go through a painful patch. They go through a period wherein, markets hate them. Now, of course, I'm not saying that, one should blindly buy them, but if we are able to evaluate them fresh through a fresh lens and see whether, these are companies which can continue, I would say that, the chances of investing can go up quite meaningfully. So this is something that I would say is, my holy grail, to see if there are companies which can do that. And obviously, you never set out to know whether you're buying into a compounder, let alone a super compounder. All this aspect of multi-bagger, etc. I don't think I've never bought into a company saying that this is going to be a multi-bagger. It's always that, okay, can it create value? Can it continue to create value? And lo and behold, over a period of 5, 7, 10 years, they end up being 10 baggers, 15 baggers, etc. It is an incidental thing. It never was the starting point of the investment thesis. And therefore, I would say that, these are some incredibly talented companies. Um, World's longest bull market, very quickly. It's basically, we are talking about the population from 2 people to about 700 crore. The CAGR is only 0.03%. The important point I'm trying to say is that the time that you're going to do, if you're going to start young, which all of you are, most of you are, I think it's an insanely powerful thing. If you have not looked at it, look up rolling returns. I think it's a very powerful thing. I'm not spending too much time. This is the aspect which I think you should focus on, which is to create a journal. Before investing, you need to have a journal wherein you write your thesis beforehand. It could be a 3-liner, 5-liner, whatever be it. Like I said, I spoke about the 5-question game. You bring in those 5 questions and then you introspect. Uh, it will insanely help you uncover the mistakes that you have done, learn from them, make new mistakes, right? And therefore, this is something that I would say. These are some of the books that have helped me. If I was a B school student, the first book that I'll read would be the last book, The Economic Organization of a POW Camp. It's a 14-page book. Strongly urge you to read it. It's the most fascinating thing that I wish I had learned it 20 years back. So yeah, I'll kind of stop here. I think I've taken a lot of time. Wow, I didn't anticipate it going so long. Sorry for that. But yeah, open for any questions. But up to you how to take this forward. Thank you.
Thank you so much, Harish sir, for that wonderful presentation. In fact, quite a lot of questions we have collated at our end, and some of those questions have been answered, but still, we'd seek your guidance through the course. I would like to moderate those questions on behalf of the students, if that's okay with you.
Sure.
And to keep the session more productive, what I've done is I've already collated few questions which our alumni have shared with us after reading Substack, your blog, and then eventually, we have collated this list of questions which I'd like to share on screen, and then maybe if we can, go through each of them, if it's okay with you. Shall I get started?
Sure, please.
Thank you so much, sir. So the first question from our alumni is, in one of your threads, you mentioned that as an allocator, it's really important to keep sense of long-term trends now, as they can have a meaningful impact on investor returns, even if it's as simple as buy and hold strategy. The question of our alumni is, it's more on the behavioral aspect, like from a, let's say you identify a sector from a long-term hold story perspective, you really love a company in that particular sector. And now that you have entered that stock, how do you go about weighing the quarterly results when, let's say, if there is a slippage in earnings of one quarter due to high stock performance, price breakdown, or a margin fall due to raw material prices? How do you incorporate that?
So, like I said, it's basically a part of your investment thesis or philosophy, right? Now, we don't give too much weightage to quarterly earnings. Obviously, it's not to say that, we don't listen to calls or we don't look at how companies perform, etc. But the reality is, like I showed you in that chart, right? Predicting near term is, I would say, a fool's errand. It is not something that at least I am very good at. So what I would look for is more in terms of consistency, and consistency from two aspects. One is in terms of the narrative that the management teams had set out for, in terms of what they are wanting to build, how they are looking at growth over the next 2-3 years, and are they continuing to be on that journey? What we typically get more worried about is, companies giving one excuse after another excuse to say, nahi, ye ho raha tha. The 2 quarters later, they'll say, nahi, nahi, ye nahi tha, something else, we are trying something else, etc. And that typically is a slippery slope, because you know that, at the end of the day, this is valuable money that you are allocating to ride on somebody else's behalf, on someone else's coattails. And if they are not so sure, would you be better off doing that itself? So therefore, I would say that, that is an aspect that we are more bothered about. See, at the end of the day, like I said, we all make mistakes. Now, in this business, if there has been such a judgment mistake, it is better that you cut your losses and move on to the compounder. So rather than persist with a stock wherein the thesis has changed, or where the business environment and the regulations, and more importantly, the narrative spun by the management keeps changing, and believing in that, you are better off moving into a compounding kind of a story, with if you are not finding a buy idea. But I would say that, we give a greater focus on the return ratios and the ability of these return ratios to sustain, rather than looking at quarterly earnings, etc. But yeah, this is a judgment kind of a call, right? I don't think there is any right or wrong answer. And over time, we all have. All I can say is, typically we give between 4 to 5 years for companies. This is an average. Of course, there is a tail wherein we are out even in, say, 6 months or 9 months, wherein we got the call wrong. And therefore, we need to be quick to cut our positions and move into the market portfolio. But yeah, so that have been maybe about 10-15% of our decisions have ended up like that. But generally, I would say a lot of our decisions have a 2 to 3 year kind of a vintage. Some of them have even a 7-10 year vintage, especially the compounder kind of a names we tend to hold for much longer. So yeah, that's the way we look at it. But we are not so fussed about quarter earnings. Neither are we so fussed about stock price breakdown, etc. The other thing that we generally look at is, obviously there is one camp that, if you bought something at 200, and if the stock is at 100, and if you've done your job, which is very well, at 200, you should buy even more at 100. Now, I think, at least in my mind, like I said, we work on imperfect information, incomplete information. And if that is your starting point, to say that, you've done a lot of work at 200 and therefore to double down, I would say that is not something that we do. Right. In case there is a bad patch, a sectoral headwind, we will continue to remain in that name, but we are not going to further compound our misery by adding till the business fundamentals and the sector tailwind comes back into that space. We wouldn't want to add on to that misery. So those are some of the ways in which we have kind of sharpened. What you're talking about is the self-discipline, but yeah, it's still work in progress.
Got it. So thank you so much for the detailed answer. The second question, in fact, is again in conjunction with what we were discussing. So let's say in your threads, you've discussed value investing and growth investing, and we are very well aware that sometimes value investors have this curse where they are too early into entering a stock. And as we very well know, markets can be irrational for a rationally long amount of time. And in such a situation, how do you react where the business is significantly improving, but the stock isn't really doing anything? So how do you go about taking a look at
So, see, obviously we are professional investors. I mean, we are, and therefore the expectation is that, we don't have too much time wherein we can say, कि हमें 10 साल दे दीजिए and, these stocks will do. I mean, I wish we had a lot of such investors, and I'm aware that some people have it. At least, sitting where I am, I don't think I have that luxury to say that, give me time for 5 years or 10 years and see how the strategy works out. So we have to be realistic, right? So now, how do you be realistic is where risk management really comes in. So firstly, you want to be in multiple such bets. So even if you're a value investor, my opinion is a concentrated value investing. I'm not so sure, given the horizons that we operate in, has got a very good chance of experience for the investor or for the manager. So therefore, we want to be diversified. So I give you examples of various sectors which are in the bottom half of their profit pool share, right? Now, if I go blindly and say that, I'm going to buy this sector or that sector and buy, say, 5 stocks in that space. Now, sometimes I may get incredibly lucky that this can play out in the next 1 year itself. But often what we have found is that, you don't tend to keep getting these streaks of luck. So what we look at is firstly diversify across multiple such sectors. So you are going to have, say, cement, you got, say, pharma, you got, say, capital goods, you got, which are all at the bottom half of their profit pool shares, right? Similarly, uh, what we want to also have is that a lot of these typically need to have catalyst. You don't want to buy something just because they are cheap or they've been great in the past. Markets are forward looking and want to be excited of what is going to happen in the next 12, 18, 24, 36 months. And therefore, you need to know that, how this stock narrative perception of this company and the business fundamentals of this company is going to change over the course of the next 12, 18, 24 months. And which is where I would say that you need to have the catalyst ready. In case the catalysts don't come out as expected, you will have to have a revisit. There is no point in loading up and saying that, I am right and the catalysts are not going to come through. So I think these are the two ways, diversification, risk management, and having a very visible catalyst uh, given the time horizon of our portfolios. So if I had genuinely 8-10 year horizon, possibly, I could afford a lot more discretion in buying, buying companies, even where, say, the next 1-2 years companies, stock price doesn't really reflect their business earnings. Unfortunately, or fortunately, however you want to look at it, I think our horizons are slightly more shorter term, which is more in the 3-5 years, which is also much higher than most of the other investors, which are either day traders or looking for the next quarter, etc. But I would say that is where our sweet spot is as a professional money manager, and I would say that that is how we deal with these eventualities.
Thank you so much, sir. That did answer the question. Sir, we do teach. So I think in in your presentation, one of the slides we were talking about structural trends and how reversion of mean happens when you take a look at a macro data point. This is actually in conjunction to that. So in one of your media interviews, you mentioned that. Pharma profitability to overall profitability is around 15-year lows. And I think we skipped that slide because of the time crunch.
Right.
So I thought, probably it's been covered here, so I didn't really. So, what are the few structural trends that you see in favor of pharma that makes you bullish for the next 3 to 4 years? And even within pharma, any subsegments, categories, or geographies where you are bullish on, along with, maybe reasons, if you can help us understand, so that we get your perspective, how you take a look at about judging structural trends rather than cyclicalities.
Sure. So pharma is a difficult space, but I'll still give a shot. The reason why it's difficult, in my opinion, is pharma is very bottom up in the sense that how a company is dealing with a particular molecule, its strategies, they are very heterogeneous. It's not a homogeneous sector wherein overall, the trends will impact everything and anything. Say compared to the IT sector or say the financial sectors, which are still a lot more top down and homogeneous as a trend point of view. Having said that, why is it that we look at these reversion tools? Okay, and maybe I'll give an example of IT, and I'll come to the pharma. I'm not trying to dodge it, but I'll give the case of IT. So if you look at the narrative of IT today, is that you are going to go through a recession, you're going to see a slowdown, etc., etc. Right now, the reality is neither me nor you nor anyone knows how the next 12 months, the next 18 months, etc., is going to pan out, right? The reality is that over the last 18 months, this narrative has been always there that a recession is coming, it's coming, etc. And therefore, in any such thing where, a concern has been flagged off for so long, chances are businesses have already started learning how to adapt to this new environment. Of course, there can still be shocks, there can still be a surprise, but those will tend to be short-lived is the general sense, because that's how the past 20, 25 years of data that we look at is looking at. So when I look at, say, the IT sector, okay, to start out with, and then I'll come to the pharma, it's generally been a growing sector in terms of its relevance of profit pools as a percentage of total profit pools. So if I look at, say, 2001 to after the dot-com bubble burst, IT profits as a percentage of total profits were about 5%. And then it went up close to about 8% in the 2007 pre-GFC kind of a boom, right? And then it fell down, and then it started going up again to about 12, 13% by before COVID. So generally, and obviously every percentage point improvement means we are talking of a very large growing pool of profits. And in that also, these companies doing better than the overall profit pool. Now, during COVID, because of reasons that we all know, which is that, there was a lot of demand, as well as the fact that there was margin improvement because there was no spending on travel, etc., etc. This one went all the way to 15%, and from there it is now currently close to about 9%. So 9% is where IT sector profits used to be in 2013. So the call that I would take is whether 9% is likely to go back to 12, 13%, what was there pre-COVID, or is it likely to go to 8%, 7%, or is it going to be staying at, say, 9%, right? Or where we are today. And that's a judgment call, right? And that judgment call is basis of the past trends, the fact that at least my base view is that digitization, etc., is going to be even stronger. And of course, there will always be narratives that Chat GPT can displace, etc. And that is how perceptions of companies will move from one extreme to the other extreme, right? And there's no right or wrong about it. But if you've got a 3-year view, I would say that my base case is that it'll go back to the pre-COVID level, which means that you are talking of a higher earnings growth. And that higher earnings growth can come through over a 3-year period, courtesy maybe margin improvement, because margins have corrected quite significantly. It could be the fact that initially there will be a demand slowdown and then again a demand flush coming through. It could be the fact that currency may see a far more depreciation. And these are all things that you will not know sitting today, how it can play out. But the call that we have to take is that can it go up or not. Now, coming to the pharma space, okay, because pharma is a very interesting space, because if you look at the narrative from 2010 to 2014-15, where insane amount of money was made in the pharma sector, it was always that this is an evergreen space. India is the diabetes capital, India is the heart attack capital, so many lifestyle diseases are coming, blah blah blah, and therefore this is a space that can create insane amount of wealth, and they did create. But in the last 5, 7 years, you are starting to see both positioning of people as well as the broader narrative saying, nahi yaar, pharma mein bahut sare issues hai. There is FDA audit, there is this. The fact is that, where companies' bets in generics have not paid off. People are moving into biologics. Indian companies are more in chemistry, not in biologics, etc., etc. And these are all valid points. Don't get me wrong. We are never saying that, all of this will not play through. But what we are saying, or what we are kind of thinking at this point of time, is that this is a space over the course of the next 3, 4 years, where it is at the 15-year low of profit pool, can potentially revive back. And this is where the margin of safety comes through, wherein the last 5 years returns have been abysmal. The fact that ownership levels have come down, all of these points to the fact that in case one or two of these factors go right, your margin of safety can improve quite meaningfully. Now, what are those one or two factors that can go right, which is what I guess the import of your question was. I think what can go right is basically capital discipline. So if you really look at what had happened, was that initially, most Indian companies used to operate only in India, and India was a phenomenal market because even manufacturing you had outsourced, you just had a field force, uh, fragmented market, but throwing a lot of cash. And companies like say 3 or 4 companies then decided to divert this cash into US markets, because that was the focus of genericizing. This I'm talking of the period of 2000 to 2010, 11, etc. And three, four large companies made that transition, and seeing the profits of these three, four companies, every other pharma company went to that same direction, regardless of the working capital cycle, which was insanely longer than India, or the fact that you needed to have a higher quality standard, etc., etc. Which meant that now for every molecule you had, maybe instead of say 5 filers or 10 filers, you had 50 filers, which meant that the overall profitability went down quite dramatically. So now we are starting to see vacation of a lot of fringe players. Again, it's not going to go back from 50 all the way to 3 or 5, but 50 is likely to go to 45 or 40 in our view, which is where we think that the pricing climate can actually improve rather than worsen from here. And therefore, some amount of pricing discipline can come back into that sector. Um, of course, the overall narratives of being an evergreen sector in terms of the lifestyle diseases, etc., continue to remain. And while a lot of people are focused on, diagnostics and hospital chains, etc., to play that, I would still say that the Indian pharma companies are actually a much better way to play that rather than through the lens of this. So, of course, there is disruption, there is a whole change, and change is, going to always be there. You're going to see consolidation. You're already starting to see, right, players vacating and selling, consolidation. Now all of these, I would say, are good signs wherein capital discipline starts coming back, and which is what can trigger value creation in the space. The fact that the last 5 years has been poor, the fact that profit pool share is one of the lowest, the fact that promoter holdings in a lot of these companies have gone up, the fact that there is consolidation and people are focused on capex, wanting to spend wisely. I think all of that points that over the course of the next 3 4 years, there is a decent probability that we may be positively surprised than being negatively surprised. Again, it's only a probability, which means that you don't bet your house onto it. You want to be diversified. Within that, also, you want to look at differentiated businesses that have an edge over the rest of the competition. All of those basics still hold true, but that is how we would look at pharma as a space.
Thank you so much, sir, for that brief answer. I think the next one was covered in your PPT, so I'm just going to skip to the fifth question. The question from one of our alumni is on the blue chip fund. Now that the fund is actually a large cap fund, and more or less allocation goes towards heavyweights of Nifty, and since everybody is behind generating alpha, how do you go about generating alpha in such a space where there are very little space to invest in the first place, and how do you go about thinking of generating alpha in such a limited constraints?
So I've been incredibly lucky that the last 10 years that I've managed, in 8 out of the 10 years we've generated alpha. So in an otherwise difficult environment of generating alpha, I guess we've been lucky, and maybe we have also been blessed by having a disciplined process to hope that the luck has worked in our favor. So what has worked and the way we look at generating alpha in this space, and I mean, this is the prevalent narrative, right? These are all discovered names. So why should there be any alpha creation? These are such research names, etc., etc. But I think the reality is none of this is actually true. If I were to think from a first principles level, the reality is you need to be different from the overall market to create an alpha. And you need to have a slightly different thinking in terms of how to do that with a process. So how we look at this space is in 3 dimensions. Okay. The first is that we are looking at the Nifty sleeve, okay, which is what the question also was, which is the top 50 companies. The second sleeve that we look at is the Nifty Junior sleeve, which is the 51 to 100 companies. As most of you may know, 1 to 100 is large cap, and funds at any point of time have to be present at least 80% in that universe, right? So these are the 2 sleeves. And the third sleeve is mid caps, or the larger mid caps, right? Now, how do we straddle these 3, and what do we look for in each of these 3 buckets? So in the first bucket of Nifty, our focus is elimination. So what are we eliminating? We are eliminating Me Too companies. We are looking at companies whose profit pool share over a period of time is going to keep declining as a percentage of overall profits of Nifty, which means that over a period of 2, 3, 4 years, a lot of these companies will actually go out of Nifty. Okay. So we did this analysis over the last 10 years that I've managed this fund. There have been 30 stocks that have exited from that of Nifty, and we were not present, if I'm not wrong, in 26 or 27 of them. Sorry, we were not present in 26 or 27 out of them. So that really is what I would say, a hit rate. Because otherwise you've got, like I said, a 51, 55% hit rate. Here we've got an outsized hit rate. And that is by focusing on companies, which I'm not talking of the next 3 months, 6 months, but we are talking of over the course of the next 2 years, 3 years, 4 years that have gotten out that we've never invested in, right? So over a period of time, our focus in the Nifty sleeve is what not to invest in. So we look at about 55 to 60% of the fund to be invested in the balance 20 or 25 companies. We don't invest in anywhere between 25 to 30 Nifty companies because we think that there's a reasonable chance that many of them will go out. Okay, so that's the first sleeve. The second sleeve is basically the Nifty Junior, or basically 51 to 100 companies. Over here, our focus is that can we identify 10 to 15 companies which over a period of time can get into Nifty over the course of the next 1, 2, 3, 4 years, right? And again, the same stats, out of 30 odd companies that have entered Nifty, we were present in 19 of them. So not as good as the elimination, but still materially better than that 50, 55% kind of a hit rate that we spoke about, right? And which is what that we think that, these are companies by virtue of being larger and faster growing, over a period of time, they'll capture the imagination of investors, and therefore their perception or re-rating, quote unquote, starts coming through, which means that there is a decent chance that over a period of time they get into Nifty. So that's the second basket. The third basket is mid caps, wherein we are looking at opportunistic basket of say, 10, 15, 20 companies. We typically tend to have between 15 to 17% weightage in these companies cumulatively. And here the concept or the idea is that can we look at these companies which are maybe mispriced, where we see, over the course of the next 18, 24 months, some kind of a catalyst in the horizon. As and when that catalyst comes through, you get out of that company and replace it with something else. So if I look at these three components, which is Nifty, where our primary focus is to be on the compounding side, on companies which are likely to keep growing their profit pool share higher. Nifty Junior, where we think there can be a scope wherein there can be an acceleration in profit pool share, and which over a period of time can get into Nifty. And the third, which is primarily on the mid cap slide, wherein we are looking at, catalysts in the horizon. I think a combination of these three, typically the Nifty Junior, we give a lot of time for these companies to come through. It could be say 3, 4, 5 years. Mid caps, where we give anywhere between 18, 24 months for the thesis to play out. A combination of these three, generally we've got a turnover of about 15-20%, which means that we typically give 4 to 5 years for this for a company to execute its plans. And that is how we have kind of created a process and a discipline and a way to create alpha in an otherwise difficult category through this process. And of course, the underlying framework is the best of breed framework in terms of stock selection, etc., to arrive at that.
Well, that's definitely not luck, I must say, with a hit rate of such a great on the elimination front as well as the continuous addition front for prospective companies. You were far too modest and humble when you mentioned that we were lucky to be there, but obviously it's far much more attributable to luck, to skill rather than luck in your case in this scenario.
Fingers
Thank you
crossed.
so much for that. Thank you so much for that answer, sir. So the next question was partly answered by you when you were talking about structure and cyclicality, when you were trying to answer, the value investing part as well as the previous one. So I'll directly skip to the second half of the question submitted by one of our existing candidates. You figured, so the candidate is saying you figured out an important anomaly between FMCG sector and IT sector, where both have same earnings volatility broadly, but market cap volatility is very much high in case of IT, but not in case of FMCG. Have you been able to narrow down the reason behind the same? And how does one go about incorporating it when it comes to allocation across sectors?
Reasons can be many, and I don't think we are journalists or opinion editorial writers to come out at reasons, because at the end of it, this is what has happened. But I think what we look at is more the assessment of can this sustain? Let me put it this way, because in my opinion, volatility is like a coil spring. Okay, there can be many reasons. It can be perception. It can be the fact that many people have made so much money in FMCG companies. Dividends are only accounting for their initial purchase price. Blah blah blah. Or it could be the fact that these are cornered companies, quote unquote, wherein a lot of floating stock is cornered. At the end of the day, all of these are strawman kind of arguments, in the sense that there can be many ways in which they can hold on, but I don't think that there is one key thing that can give you convincingly that what it is. So the point that we are trying to make is that volatility is a coil spring, and therefore one shouldn't expect that what has worked in the last 5 years to necessarily continue to keep working. And over here, I would say that FMCG businesses especially got the benefit of significant margin expansion in the period from 2010 to 2018-19. Even though sales kind of they initially grew quite well, especially post GFC, the next 3-4 years, and which is what catalyzed that great re-rating and the great interest in the space. But especially in the last 4-5 years, where volume growth has generally been a lot more subdued, a lot of heavy lifting happened on behalf of margins expanding for a lot of these companies. Companies that used to operate at, say, 14-15% margins on the EBITDA side now operate at, say, 23-24% margins, which is phenomenal execution by these companies, no doubt about it. But the reality is, I think a lot of people, in my opinion, are still anchored that this can continue. And therefore, this element of surprise is what can come through. I would think that there is a reasonable chance that even as there is sluggishness in the top line, I think a lot of these margin wins that a lot of companies got through may possibly dissipate, and it might become harder and harder. Obviously, every margin. So in the 90s, for example, these companies were operating in single digit margin, 5%, 6% margins. So they moved from 5% to 15% to 25%. But can these companies move to 35%, etc., in a reasonably competitive market wherein there are a lot of new launches, etc.? I'm not so sure. Maybe there is an element of surprise that can come through, but I think the narrative that has worked for these companies, wherein regardless of how their earnings come through, we won't sell, or these companies, therefore volatility has come down. I think over a period of time we'll start questioning, and because this is how it has always been, right? There are always businesses that get into the limelight, sectors that get into limelight, and over a period of time their halo, quote unquote, starts rubbing off, waning off. And that is where I would think that maybe even if there is no significant increase in volatility, there can be a prolonged period of time correction, that over a period of time, people will start questioning whether we need to have such a thing. So I think, like I said, I don't really have any particular one or two reasons as to why this anomaly persists. But all I can think of is that, this is something which will correct. I don't know when, but more importantly, I shouldn't be anchored to what has worked in the last 5-10 years as the basis of my thesis going ahead. That's the important message that I at least take away from this analysis.
Thank you so much, sir, for that answer. Sir, you wrote one of the blogs, economic growth leads to market cap gains, and you've tried to explain, the market cap to GDP ratio, very well tracked ratios, and how is it that, it depends a lot on starting valuations, whether you'll be able to make money in that. How do you go about valuing markets or sectors? How do you take a look at market valuations?
So see, it's both an art and a science, but like I said, higher you go up, mean reversion or the gravity of valuations will start hurting, right? So you can't continue to keep believing that valuation re-rating will keep happening. So firstly, I would say that, like I said, Our greater focus is on two broad businesses. One is the compounding businesses, and second is cyclical businesses where you buy where profits and ownership levels and market cap share levels are at the bottom half, so that over a period of time, at least few of these sectors, some of them can do in next 12, 18 months, some may take 2, 3 years. But if you're diversified across 4, 5 such sectors, at least one or two will start moving through, and that is how you start creating differentiation and being ahead of the rest of the pack, right? And one such ratio that I track, which has helped me, is clearly that of either price to sales or EV to sales. Because while markets tend to be very focused on earnings, I think that sometimes for various reasons, especially in the second pack of the cyclical pack, earnings can get battered out of shape, and therefore and obviously every quarter of disappointment, every 6 months of disappointment, the valuation continues to get derated. But I would think that price to sales is a far important metric, which wherein you get a reasonable sense of where markets typically think that a company of that particular size and scale should operate in. Um, Generally, I've found that to be a good turning point, especially when we look at collective price to sales. Again, individual stocks can be misleading, but when I look at collective price to sales or EV to sales, etc., you do get a sense of where some companies get obscenely valued and some companies get junked completely, or some sectors get junked completely. And therefore, that is something that I look at clearly. Uh, in terms of other valuation parameters, I think what we typically get wary of is our assessment, and this could be judgment clearly, we could be completely wrong, is that we tend to look at what the cash flows that they are generating over the course of the next 3, 5 years basis, what either the management commentary and track record has been, or the past track record has been. And we start looking at how much of that cash flows is going to get back into the business, and whether the business has the capability to absorb so much of cash flows, and whether it can continue to maintain those high cash yields or return on incremental equity. So let me give you an example so that I can clarify. So there are these companies like, say, government companies or platform companies which are blessed by government, right? Now, these are companies which, currently possibly do about 1,000 crores of profits, etc., which is phenomenal, right? Now, they are platform, internet companies, ticketing companies, etc. But the question that I often ask is, a lot of this growth that has come through was either because of a government diktat that gave them the free ride or a monopoly status, etc. And this was built on the fact that they didn't actually have to invest beyond maybe say 50 or 100 or 200 crores in software or in technology or in terms of people, etc. Their investments were very small, which is why today the ROEs, etc., look phenomenal. But when you've got 1,000 crores and let's say that they have to reinvest back 400, 500 crores every year, so over a cumulative block, say 2,000, 3,000 crores, and then you start looking at which are the areas that they can look at investing such huge capitals of money. That is where you start getting really worried about valuations of these companies, because that management has no track record of uh, deploying capital of that scale, because in the past they have hardly deployed maybe 300, 400 or 500 crores over the last 20 years, and now they are being asked to deploy something to that scale. Secondly, they have no way, or they have no idea or no marketplace where they can deploy such high value, and which is where they then end up doing something in my opinion quite diversification into unrelated fields. They start building restaurants, they start building hotels, catering stations, etc., etc. which then that the incremental returns are going to get diluted quite significantly. So in many cases, when we look at terminal values and valuations, I think a lot of mispricing typically happens is by quote unquote the sector that they are operating in, and you start saying that okay, all other companies in the sector operate at X valuation, and this is operating at say X. 30% of X, and therefore that is a mispricing. But I would say that they should not even be at say 50 or 70% of X, because there is no reinvestment capability of these companies, which means that over a period of time, terminal value is going to erode quite meaningfully. So those are the ways in which we look at valuation. But like I said, it's more art than a science.
Thank you so much, sir, for the detailed answer. So moving to the next one, how do you go about generating investment ideas?
So I think we did cover quite a lot of aspects of
In
this.
the Nifty 50 part.
Yeah, so Nifty 50. So at the end of the day, we are looking at best of breed, right? And when we say best of breed, we are basically saying that companies that have got pricing power, that are gaining their mind share and market share. So our starting point typically has been that which are the companies which are gaining on that front, which market share, mind share can be sometimes objective, sometimes they can be very fuzzy. We look at capex share in a particular sector, because these are, into our mind, leading indicators. Companies that invest heavily, hopefully profitably without going broke, are sowing the seeds for the next future cash flow streams, right? So that is one area that we look at. The other area that we look at is how is the DuPont, or how is the returns getting generated? What is the ROE, ROC, and how have they generated in the past? Obviously, what is past has already happened. More importantly, like I said, we look at what their future potential cash flows can be, and can they continue to keep at least maintaining their return ratios of what they have generated in the past, and how that is likely to trend at. So one of the key things that we look at is the incremental return on investment capital, how that is tracking. And we break that down again into, all the three layers, which is asset turns, profit margins, and the leverage effect, and try and see where is it that we start getting a greater sense of. And from a valuation point of view, we look at, especially for a lot of these best of breed companies, they don't come cheap, especially when it comes to headline valuations. And we are okay with that. We are not really looking at buying, very cheap companies. So our primary focus is, have they meaningfully underperformed, and which is where we look at the ownership share, we look at the market cap share, and try and arrive at a thesis. So from a concept or from a philosophy point of view, the way we look at is BMV, which is business, management, and valuation. And a lot of what I articulated is more on B and M. Like I said, valuation is important, but we are not, saying that, we'll never buy beyond 10 PE or 15 PE or 20 PE, etc. Especially in a cyclical business, we may end up buying even at 50 PE or 70 PE, wherein we think that, earnings are depressed and something can meaningfully improve. So those are the various ways in which we also, just to kind of complete, we pay a lot of focus on what companies do in difficult times. In difficult times, if they have cut costs meaningfully, that is something that we are very appreciative of. And cutting costs, obviously, there are trade-offs. We don't want to cut costs just for the heck of it. But if you can continue to remain profitable, if you continue to remain relevant to their customers, and yet cut costs because maybe the sector is going through a bad patch, we think that there can be significant operating leverage once the sector comes back on track. So yeah, those are the many ways in which we look at ideation.
Got it, sir. Thank you so much, sir. Sir, do you take a look at other asset class factors or other macro movements when you take a look at equity market valuations? To be specific, we're talking about bond market valuations or bond market movements here. Any particular factors which you keep a track of?
So for asset allocation, products that I manage, clearly all other asset classes become important, right? So yeah, it definitely is something that we keep a close eye on. But when it comes to say bottom up, or when it comes to say stock calls, I am of the view that any macro call which is going to impact every company in a particular sector. So like say higher interest rates. Now it's not that one company is going to have a different interest rates compared to others. Everybody is going to get impacted similar way. Now, obviously, some of the companies can continue to be okay with higher interest rates. Some others may not be. What we are constantly worried, or what we are constantly focused on, is a particular variable going to have a disproportionate impact in the competitiveness or the strength of a particular business. And as long as it does not make a meaningful change, I don't think we are very obsessed with macro when it comes to bottom up stock calls. I mean, obviously, at the end of the day, if in case, say, for example, interest rates is going high, you may want to buy into less levered kind of companies, etc. So those kind of things, do it's more a question of weighing schema, if I can use that, to arrive at. But we don't necessarily look at macro from an individual assessment. So macro is something that shapes overall risk profile. It shapes overall weighing schema. It shapes overall asset allocation. But beyond that, does it really influence our bottom-up stock ideation or bottom-up stock selection? Not really. We are not too fussed about that beyond a particular point.
Got it, sir. Thank you so much. So I think the next part we've already covered on the valuations. So I'm just gonna skip that part. How do you go about judging whether something is already priced into, let's say, the market cap or EV of a particular business? How do you establish margin of safety? Would love to understand your thoughts on this process.
Sure. So I think, like I said, and I'm repeating it often. It is a science and art. Okay. So I guess when we look at margin of safety, Uh, one thing that we have to look for is, how can potentially companies change over the course of the next 3-5 years? I mean, we would love to have a very long-term horizon and look at how companies can shape beyond that. But I think 3-5 years is generally where we tend to be focused on. We don't want to be too short-term oriented as to how the companies can shape up in the next 1 year or so. Generally, I would say 3, 4, 5 years is where we are looking at how companies can shape up from. And so, obviously, business as usual, is very easy to say that, past trends can get there, etc. But typically, we want to look at, what is it that the company is doing differently over the course of, or which is already done over the course of the last 1-2 years, that is going to shape the overall growth profile coming through the next 3-5 years. So obviously, it is in the context of whether the businesses are adding value, in the sense that can they continue to redeploy a lot of their earnings back into the business and continue to keep compounding, is what we are constantly focused on. Some of the aspects that start getting worrying, or that we focus on when it comes to is when we look at both in terms of significant stock price outperformance compared to the broader markets, wherein we think that typically comes through. The second thing that we've generally observed is sometimes sectors catch the fancy. And so when we think of, say, outperformers or multi-baggers or doublers in 5 years, etc., a chart that I presented, we can break it down by sectors. And generally, when we look at it, you start seeing patterns wherein, even the worst company typically tends to be a multi-bagger during that short time frame. And that is when you start getting worried that, not only the best of companies within that particular sector have got appreciated by the market, but the market is constantly diluting its focus and going deeper down the curve. And so, if just the top companies of a particular sector get appreciated, obviously our focus is on that cohort, so we would be very happy. But ultimately, market, then believe that same expectation of what has got delivered by the top of the cohort or the best of breed companies going down the curve. And that is where I guess, chances of going wrong meaningfully increase. So we look at the breadth of outperformers in a particular sector to also gauge that, even the worst run companies in that particular space have got insanely valued and insanely rewarded their shareholders. And that is where we think that that's something that can go wrong. There is a Substack, since a lot of your questions are from my Substack. There's something that I posted on disgruntled companies or shareholders and happy shareholders. Again, companies that historically have not rewarded their shareholders over the course of the last 15, 20, 25 years, over rolling periods of 3 years, 5 years. I'm not talking about point to point, etc. But historically, we found, if I'm not wrong, the number of disgruntled shareholders have gone up to almost 30 or 40% of the overall universe, which used to be only about 10, 15%, say about 10 years back. So more and more companies are starting to disappoint their shareholder base. Again, if you see that a greater amount of outperformance coming from these kind of disgruntled companies, again, we get the feeling that, markets are scraping at the bottom of the barrel to try and get that additional alpha, or to try and get that additional return, which is again something that we would be wary of. So again, like I said, there is no one answer. But a combination of all of these signal, the sector ownership pattern, the sector's market cap share patterns, the breadth of the sector getting rewarded insanely, the breadth of disgruntled companies doing phenomenally well. All of these are, I would say, worrying signs when we look at, and therefore we would want to be toning down risk. But yeah, sometimes, companies and sectors can continue to keep surprising, and we may be wrong on that assessment. But yeah, these are some of the ways in which we look at margin of safety.
So much, sir. Considering we just have 5 minutes left, just going off the books here, I think you've already answered 15, 16, 17. By the way, these three are our favorite questions, which we typically ask each and every stalwart to talk about. And in fact, you talked about this at the start of the series itself. So just one question, like considering mutual fund houses always have this privilege to, reach out to management and get bit more information, which is not that publicly available often at times, not that it is, something which is insider as per se, but let's say for these young budding investors who are trying to build a career in this industry all on their own, how can they go about extracting information when you yourself consider scuttlebutt and channel checks to be a very important way of looking at things? But let's say not every investor has that luxury or that visibility of a platform which a typical institutional investor like a mutual fund house as reputed as yours typically has. What your advice would be in this case?
See, it again boils down to the three edges that I think investors have, and you will have to prioritize one edge over the other, right? So if I look at the information edge, the diligence edge, and the behavioral edge, I think where professional investors like us score quite well is the very easy information edge, as you also pointed out, right? We typically get that, and to be quite honest, I think amateur or retail investors, not that I'm saying they're bad or good, etc. But today, in today's environment where you've got so many tools, I would say that access to information is reasonably similar. Right. In fact, I am of the view that, management interactions, if you ask me, the utility of management interactions has been on the decline. If you ask me, because A, the number of management interactions have kept going up, and B, the kind of questions that then get asked tend to be more short-term oriented, which actually is not going to add significant value. But be as it may, I would say that the access to that, I don't think is going to be a big game changer. What I would say, retail stroke amateur investors have a significant edge over professional investors is on the behavior or on the time horizon. And which is where I think you can really max out compared to, institutional investors like ourselves. The fact that, we can't play in very small pools of capital, given our size. and our bandwidth. The fact that our horizons, like I said, because of the nature of the money that we are managing, we really can't have a 5-year, 7-year kind of a money. We would love to have that kind of horizon, but our horizons, whether we like it or not, tend to be slightly more short term. It's not as short as a 1 day or a 1 month, but it's definitely more in that 1 to 3 year kind of a bucket. I don't think we have the luxury, and therefore, if you are playing on the other side, I think that is where you can meaningfully improve your investment hit rates. And so I would say that, especially in today's day and age, wherein, AI and chat GPT and all that can give you information, but I would say that there is too much of noise rather than information. And therefore, simplicity or clarifying on few aspects is going to be much better. And which is where I would think that, as individual investors, you actually have a significant advantage over institutional investors. And at the end of the day, a combination of institutional and individual investors is what makes a market, right? Difference in time horizons, difference in assumptions is what makes a trade. You can't be having the same set of assumptions to have a trade. And therefore, I would say that one needs to focus on those aspects rather than worrying about. And I think our regulator is actually doing a fine job in kind of disseminating a lot of information as well. So I would say that that edge is getting blunted that we have on information. And I'm talking about the legal. I'm not talking about the insider, which any which case I think is out of the window for almost all institutions as well. But I would say that that edge is getting blunted. Um, the way I would say that some people can also use is to look at the wisdom of the crowds. Wisdom of the markets can also be kind of rewarding. So if you've got factors that focus on the wisdom of the crowds, that is also something that can help you in terms of improving your hit rates. But yeah, this is something that you will have to work on your own than believing that you can have an edge on information.
Thank you so much, sir. It was truly an amazing session. And I would really thank you on behalf of each and every alumni of ours, along with existing students, for taking out time on a Saturday evening. And, we would love for a similar privilege if you'd allow to learn from you again sometime in near future. Once again, maybe with more questions and more agenda-driven questions.
Absolutely. Pleasure will be mine. Hopefully, by then I'll make more mistakes that I can share you with.
You're far too
For
humble and far too
no,
modest.
for now, these are the only ones or the collective of mistakes that I've made, and hopefully, I will try and reduce these mistakes. I'll make new ones on the way forward. But thank you so much, and thank you for a patient listening. Good day,
Thank you so
everyone.
much, sir. Have a good day,
Thank you.
sir.